the markets initially got caught flat-footed by the magnitude of Liberation Day and the tariffs, right? So we had a market that was kind of flying high, that there was a Trump put that he would protect the markets, and then all of a sudden he comes out with these massive, massive tariffs. And the market began to freak out and fell in early April because they started to doubt that Trump put. They said, oh my goodness, maybe he's more into these tariffs and he's not going to care about the stock market and the economy. And then lo and behold, what did we see? We saw the market starting to recognize that, he backed off once the bond market forced him to back off on his general tariffs, except for China, and then also on these Chinese tariffs. And so the Trump put is back on. And my thesis is this, is that the markets can keep grinding higher as long as the economy holds up, right? So whether there's a trade spat or an Elon Musk Trump feud or any of these other things, as long as the economy is holding up well enough, the markets can grind higher. But if that economy goes, that's where things are going to get messy for the markets. You look at the overall levels of the U6 unemployment, which are creeping up. So there's no doubt that the labor market is weakening, but the markets for now are willing to look at those headline numbers, focusing on that, and buyers, essentially retail. Retail has been driving this market higher, and it looks like that'll continue until we see a crack in the economy. So I do think the Fed will delay rate cuts. Now, I know Trump is pushing for them to cut, but my thesis here is that we will still see a bump up in inflation. Now, a lot of people would say, well, why haven't we seen it yet? Well, remember that before Trump imposed these tariffs, a lot of businesses bought a massive amount of inventory. And when he's rolled back these tariffs initially and given another 90-day window, businesses are buying massive amounts of inventory again. And so what they're doing is they're buying the inventory essentially pre-tariff. And that enables them to keep prices relatively stable. And that's why I think we haven't seen the inflation. But if the tariffs do ultimately end up sticking, then I do think that the inflation will start to show up. The other thing to keep in mind is that while we're seeing inflation in certain things, we're also seeing oil and energy prices go down. And that's really anchoring and pulling down the overall inflation number, right? So oil, again, trading back in the low to mid 60s. And that, again, is historically, at least over the last 5 to 10 years, relatively low. And that's keeping pressure on inflation. Yeah, so I think the key here is that we've had these investors and retail, and even to some extent now, these second-grade hedge funds that have really been saying, oh my goodness, I've got to pile in this market. And so I think the retail investor has really done well here because they've been the ones that have been targeted by the Fed and the government when the government and the Fed has come out and stimulated, right? So they're used to, and they've been programmed since the lows in March 2020 and every subsequent major sell-off, that there's a V-bottom recovery. So if you've been programmed to assume that will happen, you're going to assume that in this situation, it's going to happen again. And it's almost like a self-fulfilling prophecy, right? We're seeing the S&P, this beautiful down move, but then vertical right back up. And hedge funds have now been late to the party. They were sitting in cash. Now they're being forced to chase this into quarter end. We all know the quarter ends at the end of this month, and they have to show that they're investors, that they did well during this recovery period. So I think this combination is driving markets up, but I don't buy that it's going to last here. And I'm going to show you why. So again, remember, I'm a chartist, meaning that the charts are what speak to me. I translate it into probabilities. Now, one of my big concerns here is that if we go to that logarithmic chart on the S&P 500, a trend line that goes back to 1929 before the major Great Depression market collapse. And then that same trend line connected to the high of the dot-com era. We just tagged it here. We pulled back. We obviously had a 20%, nearly 20% drop. Now we're pushing back up. So could the markets hit a new all-time high? Absolutely, they could. But this trend line, I have to respect it and understand that every time we've hit it, we've had a major pullback, whether it was the Great Depression, the dot-com collapse, or even this recent drop of 20%. And so again, if the S&P goes up to, let's say, 62 and a quarter to 6,250, I would think that at that point, the markets will see a drawdown. And let's be clear here, folks. The economy is slowing. Yes, the headline labor numbers, okay, sure. Whether you believe it or not, or whether you think that they're going to be revised down or not, we are seeing a slowdown in the global economy and the domestic economy. And at some point, so I think we're getting close to that. We're seeing today the semiconductors, and I want to show you actually this chart in a second, but the semiconductors are nearing a major resistance level. I also think there's a tendency to always get the maximum amount of bulls on board before the rug essentially gets pulled underneath the retail investor. And so when you look at the S&P, right, and we go back to our regular chart here and we look at where we are now only approximately, let's see here, we are about 2.3% away from our all-time highs. And so what would make investors the most bullish? Where would the shorts start to panic and stop out? Well, if we broke the all-time high, where would the people that are sitting on the sidelines that aren't really believing this rally, where would they finally throw in the towel and jump on the long side of this market if we broke the all-time highs? So I think it's very plausible that we could come up to double top here, pierce double top, which would then have us hitting that longer term trend line at around 62.25 on the S&P 500 logarithmic chart, right? Going back right to here to this chart, right up here, we take out that all-time high, gets everyone bullish, thinking this market is unstoppable. We hit that line, and then it starts to come in. And I just want to show this chart too, one of my favorites on the NASDAQ. Look at this right here. And channels, again, they tend to keep price between them. But you can use the trend lines of a channel to trade very accurately, i.e. the low of COVID all the way to the high of the bull market, back to the low of the bear market, then gave us our exact 2024 market high. We then had this collapse. Now we're pushing back up. So if the NASDAQ gets to about 21,000 or 20,900, we'll slam into that level again. And my guess is then you'll see that next big fall. Okay, so here we have the NASDAQ, right? And what we see here is this is that big parallel that I was just discussing. So let me show you this, and then we're going to look at the key Fibonacci retraces. So you have your COVID low to your bull market high. You have your bear market low that gave us our bull market high here in 2024, where we collapsed off of. We've now retraced. And if we get up to this level here, you would assume a rejection. Whether or not it gets up there is kind of up for debate. And if we go and zoom in on this, we can clearly see that if we take that previous all-time high and we do our Fibonacci retrace, we're right at the 886 Fibonacci retrace resistance. So you have resistance here. Then you have your all-time high right here. You're testing your double top. And then if we get through that, there's, again, upside to maybe that upper parallel. And I just want to show you this too, because I think, we're talking about maybe a little bit more upside in the markets. But even if we go to that upper band of the parallel, that's only 6.7% higher. So again, the upside is very, very limited to me in this market. So there's a trend line here. Can you see the SMH chart there, David?
Yeah.
Okay.
Got it.
So you have your all-time high on the semis right here, and you connect it to this high, and you have a gap fill right here. Notice these two lines are right in this zone, and look at what the SMH just kissed today, the lower band of that trend line. So huge resistance on the semis here. And sure enough, we're starting to pull back intraday on the SMH. It is coming in. And these are all signals to me that the market is running out of energy. The question is, when are the economic data points going to weaken? And that's when you'll see the bigger rollover. You'll see small pullbacks here, as long as the economy stays strong. But it's when those economic data points weaken, which they will, that's when this market goes down 10, 20, 30%. Look at the facts, right? So what's different about this time? So number one, we have tariffs. And even if they do these trade deals, remember, there's a baseline tariff for everyone at minimum of 10%. And even with this kind of truce with China, it's still 30. I believe it's 30%, if not 40%, that the U.S. has still imposed. So there is going to be tariffs, and there will be as long as Trump is president. The question is at what level? In addition, what about government spending, right? So we've already seen Doge do their cuts. Now, granted, this big, beautiful bill doesn't really do much, but there are going to be cuts in that bill. In the very least, the spending won't be as maximized as what we've seen prior in previous bills from the government. The deficit essentially probably rises a little bit less, or the debt rises a little bit less than it has been, albeit probably still going higher. So there's this issue now where the government is being much more aware of spending, where they're not just going to flood the market with liquidity. And the Fed is very clearly not quite as aggressively cutting rates at this point. And so what that does is the stimulus from those factors is now missing from the core situation in the economy. And I think that one of the keys too is that we're starting to see the consumer react. Consumer spending is starting to crater a little bit. We're seeing people be much more careful about where they're spending their money. The airlines are saying people are traveling less. That big, huge travel, massive move from COVID has now expired, and people are back to normalized living and being more careful about spending. And we know the consumer is the driving force of the economy. So I think all of these factors are going to lead to a slower economy this time, where stocks will actually have a longer term down move. So the essence of it is it's going to be when the labor market fully cracks. And again, there's already cracks in the labor market. Let's be crystal clear. Last week, jobless claims jumped up to 247. The previous week was 239. If you look at jobless claims the previous month or two, it was hovering around 220. So jobless claims, which are people filing for unemployment, it's ratcheting up almost on a weekly basis now. That's a sign right there. Then you look at participation rate. Remember, participation rate, when it declines, it tells you people are saying, you know what? I've been looking for a job and I just can't find one, so I'm going to take myself out of the potential workforce. That is a bearish sign for the labor market as well. So the cracks are there. You just have not seen the glass shatter yet. And that's what I think will be the trigger towards this market decline.